markets care a lot about the rate of change of growth and the rate of change of inflation. And here, you need to be honest, clearly you are going to be seeing a positive rate of change in growth in the short term. To give you some statistics, there are countries like Germany who are effectively the largest trade partner of China. So the moment China reopens, countries like Germany are going to temporarily benefit from it. And Korea, Australia, all these open economies that are either geographically close or they have some direct business with China, they are going to benefit from it, temporarily speaking. Because the moment that the growth cyclical push is exhausted from a rate of change perspective, that's likely going to happen, say in 6 months, Adam. You are going to go back into what are the secular drivers of growth. What is the long-term, what I call gravitational pull force. And from that perspective, you are still going south, both on a growth and on an inflation perspective. Now, the market here, Adam, is basically choosing to focus on the green shoots, both on inflation and on growth. So what it's doing is, it's saying, look, inflation is going to come down very rapidly. On the piece on the macro compass, I highlighted that inflation swap traders, so the market implied expectations for inflation, are at 2.5% by late summer. So again, I want to repeat that late summer is literally in 7 months, and traders are pricing inflation in the US to drop to 2.5% by then. Wow, that's a rapid decline in inflation. So they're focusing on the good side of it. You know, if inflation comes down, Adam, that's great. It's great because the Fed has an easier life. They don't need to push so hard if inflation really comes down that fast. But they're also thinking that growth is going to be much better because China reopens. And so we avoid a recession. And at the same time, inflation comes down. That's immaculate disinflation. That's a soft landing, effectively a soft landing. And I think that it's a bit myopic to just take the green shoots coming from both angles, because let me give you another angle, for instance. China reopens. We have seen what happens to the supply chains of large economies reopening. That's the US, that's Europe, where you have temporary labor shortage because a lot of people are actually sick by COVID. So you have some supply disruptions. Then you have a lot of nominal growth activity. You have people spending, people consuming. You have the renminbi strengthening as well. So that seems to me like inflationary overall. Commodities are rallying, Adam, as we speak. Copper, base metals, they're rallying. Markets are completely ignoring that as if it doesn't matter for inflation, but they're extrapolating the growth side of it. So again, it looks to me pretty myopic, as if markets are choosing to focus on the green shoots that are there, but they are making the base case pricing very, very la-la land. That's how I would define it at this stage. Look, on the macro compass that I released free for everybody, Adam, I looked at market probabilities, because at the end of the day, nobody has a crystal ball, right? But we have to try and extrapolate what markets are pricing and what do we think instead the probabilities are for what's coming ahead. And you're right, because the market is basically assigning a very high probability, 60 to 70%. You can go and read it in the article, How Do I Extrapolate These Probabilities? That effectively a soft landing will unfold. And a soft landing means the Chinese growth push will allow us to avoid a recession. But at the same time, the Chinese reopening will not spur inflation again. So you have basically the market pricing in stuff like, again, we talked about inflation at 2.5%, but then we have earnings growing 4%. It's not very rapid as a growth in earnings, but it's still not a recessionary earnings setup, right? In a recession, on average, earnings drop by 30%. The market is still looking at earnings growing by 4%, mild growth. So we avoid a recession. People are telling me, Alf, but the bond market is pricing the recession. And that's not true at all, because in a recession, the Federal Reserve doesn't only cut rates to neutral. So the market right now is pricing, yes, 200 basis points of cuts over the next 18 months, Adam. That's true. And it's a lot. But that will be reducing rates from 5% to 3%. And trust me, if you get a recession, The Fed doesn't hold rates at 3%. A recession means people are losing their job, inflation is collapsing, profits are down 20, 30%. Sorry, but the Fed doesn't keep rates at 3% in a recession. In an average recession, the Fed cuts way below neutral interest rates. It brings rates to 1%, to 0% if necessary. In a recession, inflation goes to 0%, to negative for a certain period of time. If you look at the past history, over the last 100 years, every time you had a recession, inflation dropped by 7 or 8 percentage points on average. In 2008, people forget that, but in 2008, we entered the recession with inflation, I think, in the 5% area. And temporarily, we went into deflation on a year-on-year basis. And it only took 9 months. So if you get a recession, people are losing their job, inflation is collapsing, companies are seeing their profits slash negative earnings growth. The Fed doesn't keep rates at 3%, guys. The Fed cuts at 0 at that point. And the bond market isn't pricing that. The bond market isn't pricing that inflation collapses to 0. It's pricing a very nice, immaculate disinflation. Back to 2%, the Fed cuts rates, but only to 3%. So back to kind of neutral rates. And most importantly, Adam, credit spreads. Like, guys, I don't know what kind of recession have you ever seen or studied in the past, but there is a chart in the article that looks at high yield credit spreads. It's a very simple chart. It's the spread of lowly rated corporates over treasuries. So it looks at the cost of capital for issuing debt for these junk corporates. The average level of these credit spreads over the last 20 years is roughly 500 basis points. So, if you're a low-rated corporate, you need to pay a premium over treasuries to issue bonds. That makes sense. This premium changes as the economy accelerates or decelerates. And, the more the economy is strong, the tighter the spreads are, and vice versa. In a recession, Adam, these credit spreads are on average 1,000 basis points, 10% over treasuries. It can be 7, 8, 12, depends on the depth and on the rapidity of the recession and how bad it is. Right now, we're at 400 basis points. So again, guys, we are below the 20-year average. How can you tell me the bond market is pricing a recession? The bond market is pricing a very nice and comfortable soft landing. That's where we stand. What do I think of it? I think the recession narrative will prevail because the tightening of financial conditions has been extremely rapid, very, very vicious and strong. It takes time to work through the economy, and it's working its way. The pace of hiring is slowing down. Retail sales adjusted for inflation are negative. They're trending down negatively. So you have signs that all forward-looking indicators are looking at a recession, Adam. So we are slowly walking there, yet markets are choosing to focus on the growth impulse coming from China, ignoring the inflationary impulse potentially, and they are choosing to ignore the big picture, which is the economy is walking into a recession. We're basically pricing la la land. That's how I would summarize it.